My name's Cassandra Windsor, and I'm the Chief Economist at CEDA, the Committee for Economic Development of Australia. CEDA acknowledges that today and every day we're on Aboriginal land. Committed to recognition and reconciliation, we respect elders and we support their stated aspirations. Today, I'm coming to you from Perth, on the land of the Whadjuk people of the Noongar Nation, and I'd like to pay my respects to the elders past, present, and emerging. We encourage everyone attending today to join in on the conversation. You can participate directly in today's discussion by asking questions using the Pigeonhole app. You can enter via the live stream page or log in via ceda.pigeonhole.at with the password financial security. On Pigeonhole, you can enter your own questions or also view and vote on the questions of others, so I know which ones are the most important to the audience. And at the end of the event today, we also ask that you rate your experience in Pigeonhole. Today, we'll be addressing what the role of regulators is during times of greater market and geopolitical uncertainty, which we're certainly experiencing at the moment. And how do these regulators and others in the financial system collaborate to support financial security? We understand that current market fluctuations are causing concerns amongst both institutions and individuals about the security of their assets. And in such an uncertain environment, how do regulators operate and collaborate to safeguard stability and support long-term prosperity for all Australians? Today's discussion will address both current financial concerns and long-term retirement security, offering some intergenerational insights into Australia's financial future. We've got an all-star lineup today, and joining me to discuss everything that's going on with financial security and regulation is Tim Beresford, the Chief Executive of the Australian Financial Security Authority, Margaret Cole, the Deputy Chair of the Australian Prudential Regulation Authority, and Mary Delahunty, the CEO of the Association of Superannuation Funds of Australia. Please start putting your questions in Pigeonhole now. We're going to start with some opening remarks from our speakers, and after that, we will move on to questions. And our opening remarks are going to focus on the role of the different organisations that we have represented here today in maintaining the strength and stability of the financial system. We're going to kick off with Margaret, so I'll hand over to you now, Margaret, for your opening comments. Thank you.
Hey. Thanks, Cassandra. So I'm Margaret Cole. I'm Deputy Chair of APRA. I have oversight of APRA's regulation of the superannuation industry. And for those who are unfamiliar with us, although looking at the people who look like they were going to be attending, I think you all probably are, we're the Prudential regulator of banking, insurance and superannuation in Australia. And our primary mandate is to maintain the strength and resilience of the financial system for the benefit of the Australian community. We also have an important role in ensuring banks, insurers and superannuation funds are managing their governance, financial and operational risks appropriately so that they can deliver on their commitments to depositors, insurance policy holders and superannuation fund members. Now, this is a timely event in that I can mention that we released our latest corporate plan yesterday. That sets out our top strategic priorities to maintain the strength and stability of the system while minimising unnecessary regulatory burden. And APRA is focused on strengthening cyber resilience given the recent attacks and monitoring for emerging risks in the context of geopolitical tensions and the increased adoption of artificial intelligence. We're improving standards for board governance to ensure that board directors have the appropriate skills and experience to oversee their organisations in this increasingly complex operating environment. And we will be publishing the results of APRA's inaugural system risk stress test. And that's designed to evaluate risks arising from the interconnectedness of the banking and superannuation system. In terms of the superannuation system specifically, we remain strongly focused on ensuring trustees are acting in the best financial interests of their members. We continue to intensify our scrutiny of superannuation fund expenditure, and we're reviewing the investment governance and member outcomes of major platform providers. And we continue to drive improved outcomes for fund members in retirement. So just on another topical subject, APRA continues to administer the performance tests in accordance with the legislative settings of government. We're very open to considerations of changing the performance test where that will improve value to members. And it's important to ensure that the costs and benefits of the test are continually assessed. But changes there will be a matter for government. And it's worth noting, however, that the performance test has been very effective in reducing underperformance since it was introduced in 2021. Not a single MySuper fund failed last year's test, and the results of the latest test will be published at the end of next week.
Fantastic. Thank you so much, Margaret. And we'll move on to Mary for some opening comments.
Thank you. It's such a pleasure to be here and to join Tim and Margaret today. Thanks to CEDA for bringing us together to talk about financial security. Certainly, as you mentioned at the outset, Cassandra, it's at a time when Australians are fairly concerned about financial security, and that's entirely understandable. So my name is Mary Delahunty. I'm the Chief Executive Officer of the Association of Superannuation Funds of Australia. ASFA, as we're known, has been the voice of super since about 1962 and is the peak policy, research and advocacy body for the sector. Our membership spans across more than 100 organisations, so it's corporate, industry, retail, public sector funds, as well as service providers to the superannuation sector. Collectively, they represent the retirement savings of nearly every working Australian. Our role as the association is to unite the superannuation community and ensure the system continues to deliver dignity in retirement. We do this through evidence-based research, so we have economists and researchers in our team, technical policy development, and close collaboration with regulators and government. We do advocacy work as well as our policy development. We also do implementation work, which in a complex system like superannuation can be quite meaningful in order to keep the costs low and to keep consistency across implementation. We are also apparently in darkness now, so I've just waved my hand. We are also we're also an educator. So we have a role to educate the superannuation system to make sure that the people within it are the best professional versions of themselves to deliver for Australians. For us, I think it's fair to say financial security is not an abstract concept, because the members of ASFA are dealing with Australians' financial security and feelings about cost of living pressures and uncertainty every day, especially because we engage in conversations all the time about whether or not people will be able to retire with confidence. And it's a personal sort of ambition of mine, I suppose, that we look at this nation that is rather prosperous at a whole level and wonder about whether or not we can make sure that that prosperity extends for every person into their post-working life. And I really don't think that that sort of conversation is beyond us. Superannuation sits at the centre of people's lives. It's often the largest financial asset people will own outside their home, and it is the foundation of both personal security but also national economic resilience. In the 22-23 financial year, the number of retirees reached nearly 4.2 million people, a rise of 1 million compared to 3.2 million in 2012-13. Every week, more than $2.4 billion is paid out from the superannuation system into a retiree's bank account or hand. And that's a really tangible reminder of how critical the system already is. But super is obviously not just about today's retirees, it's also about tomorrow's. And so we have last year established a bit of a call for a national retirement income strategy. We'd like to see a strategy that brings together the three pillars of our retirement system: superannuation, the age pension and private savings, and connects them with broader policy areas like housing and healthcare and aged care. Because when you think about retiring well and doing it with dignity, it's not just superannuation that delivers that. And without that long-term view, we risk letting today's pressures undermine tomorrow's adequacy. We've got a really strong foundation to build on. 3 years into the Retirement Income Covenant, funds are developing new strategies. We can see some innovative retirement products coming to market. It's been a really good policy intervention, that Income Covenant. Assets in retirement phase now exceed $490 billion and support more than 1.3 million accounts. So the system has demonstrated fair amount of resilience during stress events, such as the pandemic's early release scheme, But that resilience can't be taken for granted. And so it depends on clear rules and fair regulation and ongoing collaboration. So it's just a thrill to be here in this conversation today, especially after a week of having conversations about productivity and economic resilience. So thank you. I'll leave my opening remarks there.
Fantastic. Thank you, Mary. And we'll move on to Tim to round out our opening comments.
Thanks, Cass, and also delighted to be here with Margaret and Mary. My name's Tim Beresford, and I'm the Chief Executive of the Australian Financial Security Authority, AFSA. What's AFSA's role? AFSA does effectively two things around financial security. The first is around our role is to regulate the personal insolvency market. If you like, ASIC regulates the corporate insolvency market, so they are corporations, proprietary limited companies. We regulate the personal insolvency market. That's mum and dad and unincorporated small businesses, sole traders, partnerships. And our job as the regulator, if you like, the referee, is to ref the match, to ensure that debtors actually get a fresh start and creditors get paid something of what they're owed. In addition to personal insolvency and the regulation of personal insolvency, we also regulate and oversee the Personal Property Securities Register, sometimes referred to as the PPSR. What's the Personal Property Securities Register? That's the register of all personal property assets, be it a Toyota truck, be it an industrial kitchen, be it a crane, be it some form of intellectual property that entitles an individual, a tradie, to register their truck such that their interests are protected. That Personal Property Security Register has all personal property assets on it. So it's around about value of around $480 billion, or roughly 20% of our GDP. To the question which Cass put at the outset about how does this all play into financial security, we'll talk about it at a macro and a micro. At a macro level, if we don't have a personal insolvency system, do the counterfactual. There are countries in the world today that do not have a personal insolvency system. In other words, what happens in those countries is both debtors and creditors sit in a quasi-zone for decades. The debtor isn't able to get the fresh start, and the creditor isn't able to actually get paid some of what they're owed, regenerate that capital and put that back into productive use. So it's a vital part of the credit system to ensure we have an appropriate and sensible way to bring things to conclusion. Equally, not only does it have a vital macro, but it also plays a vital micro. A number of people inside the personal insolvency system, let me just give you one stat, 50% of those inside the personal insolvency system have debts less than $50,000. So think about that for a moment. It's 2 credit cards. It's 5 buy now, pay laters, maybe a personal loan, and a couple of utility bills. There's a lot of financial vulnerability in the system, is what I'm saying. So we need to be empathetic in how we manage both the creditor and the debtor situation. On the PPSR side, clearly it plays to financial stability because it provides a vehicle, a registrar, to actually ensure that you know that your Toyota truck is actually secured. That if it bought or borrowed the money from a bank, that bank actually has a secured interest over that asset. It's a vital piece of credit infrastructure that we all can use to maintain the security of those particular assets and know who owns them and therefore who should be repaid should an event require repayment. Looking forward to having a conversation around how we all play in that conversation around financial security. I'll pass back to Cass.
Fantastic. Thanks, Tim. So hopefully that's given everyone in our audience a bit of a background of what each of the organisations we have represented here today does. Please keep popping your questions in Pigeonhole, and we'll, we've now got a nice chunk of time to cover off as much of those as we can. Given the week that we're in, where everything is about productivity and economic reform, I thought I'd start there to kick off our discussion. And Mary, I might go to you first. You were part of the Economic Reform Roundtable, and keen for some reflections from you on the key takeaways from the session that you were involved with, what the role of retirement, superannuation, and financial stability is when we're talking about economic reform and productivity, and what you were advocating for on behalf of your organisation.
Yes, thanks, Cassandra. It's I've come out really with a great feeling about our capacity as humans to have really difficult conversations, and I keep saying this to people: no matter what that round table may deliver. It was actually oval. Of all the round tables I've been invited to in the last let's say 4 to 6 weeks, none of them have been round. So that's something to look into. No matter what comes out of that discussion, I think our ability to be in a room, and especially with the calibre of the people who were gathered for the whole 3 days, and put our mind to some gnarlier issues is really uplifting, I think, because we can be quite polarised in our conversations at a political level these days. And so that was really a joy to be a part of. What specifically we were there to discuss was in a section that, although superannuation was represented all the way through, but I went in to discuss a section on business investment and capital attraction. And so really the way we opened that discussion was to talk about the role of super in capital deepening. And it has a role already in its existence and being quite a well-established pension provider. We did some research in the lead up to the roundtable to show that there's by the existence of superannuation at the moment, workers are $2,500 per annum better off in terms of that capital deepening because of that continuous investment back into Australia, which leads to innovation, which can then improve wages, etc. And everyone knows how the economic cycle goes. So the idea of capital attraction then back into Australia has that enormous impact on capital deepening, which then has the impact on productivity. And so we want to know how, and we wanted to discuss how not only can the Australian super funds find more good investable opportunities in the national sphere, but how did their existence bring in more international capital? And I think there's a few things to delve into there, and I could talk all day, but I won't. One of the things that really interests me is that there is often a lot of conversation about if we open up this regulation or if we relieve this constraint, etc., there will be a flood of money to this asset class. Now, let's place early stage VC, early stage venture capital in the end of that sentence, just as an example. I think a lot of the constraints on superannuation are entirely appropriate. It is appropriate that superannuation trustees have to work very, very hard for every dollar, take no haircuts, take no losses if they can, and strive to get the best retirement outcome for their members. It's not always going to be appropriate that they have a greater allocation to early stage venture capital. They might want more or less over time, but it's not the constraint of either the sole purpose test or the performance test or any other regulation that often stops that flow of superannuation money into high-risk asset classes. But in other countries, there's a lot of depth of capital market that can actually start and seed early-stage venture capital, if we're still going with that as an example, and then crowd in institutional investors over time where it's more appropriate. And so bringing a bit of a level of that conversation in the room was really important. And how can we help to build that capital, the deepening of the capital market as well as the capital deepening, which also leads to productivity gains. We also talked a little bit about regulation and where there are efficiencies to be had, which we're going to, chase down. That's a bit more low-hanging fruit. Where there are constraints that exist on investments, where those investments are appropriate for super, we want to have a look at those as well. So it was a really free-flowing conversation and a lot of goodwill in the room.
Excellent. Thanks so much, Mary. Tim, I want to bring you into the conversation here, and in terms of how ASFA is supporting the government's growth and productivity agenda, and how you're responding to the authorising environment that you have there.
Yeah, look, thanks, Cass. And look, I think one of the real powerful reflections of the last couple of days that both Mary and you've been to is it's creating a conversation. It's creating a really important conversation for the country, and I was quite buoyed to hear Mary's reflections and more broadly the reflections of others, and it's creating a conversation for regulators too. About how, as regulators, we think about our authorising environment in a way about how we are, really helping that productivity agenda, and what we are doing in that space. I mean, just as one tangible illustration of that, all regulators or economic regulators just recently wrote to the Treasury to just share some observations about what we can individually do, and that's part of this conversation. And I think what it gets to is it gets to a conversation around, and Mary touched on it a bit earlier, as the referee, as the regulator, if you will. It's about having really clear rules. So all of us can reflect on our favourite sport, be it netball or rugby or whatever it may be. But where the rules are really clear and people really understand the rules, the game flows, the match flows. And so, therefore, as the ref, the regulator, you can let the game flow and go. Where there's misunderstandings, misinterpretations, indeed, dare I say, misuse, because people are, in my space, deliberately and willfully being manipulative with vulnerable Australians, then, obviously the regulator will need to step in, because there is some community expectations not being met, and we need to deal with that. But clearly, where the rules of the road are clear and people, if you will, swim between the flags, then the regulatory oversight can be light and the game or the match can play. So that's kind of like a really important part of the discussion. I kind of like think of, if we can get the system to work effectively by understanding how best to play the match, by having clear articulation of the rules, the lion's share of people will actually play by the rules of the match, and the game or the match will flow. It's the edges. I refer to them as the edges. It's the edges of the system where there's obviously either a level of systems vulnerability, and in my world there is some vulnerability, and at the other end where there is deliberate and willful misuse of the system. And that's where sometimes we'll have to bring out the yellow card and the red card.
Great, thanks, Tim. I think that was a really clear explanation. That was excellent.
Cassandra, can I come in on
absolutely? I was about to throw to you, Margaret. So perfect.
Before we move on, if we were going to, I think all those things are very important, and we are really in the business. To mention these letters, we've sent letters to the Treasurer, to them. In fact, we hope they'll be published in due course, where we're offering, I think, really tangible examples of things that could be differently, so that as regulators we can be more efficient, we can free up areas where there doesn't need to be so much regulation, and there could be lighter regulation. We all have to pull back to our individual mandates. We are an ecosystem, but we're all focused on different parts of the system. So for APRA, that is a focus on safety and soundness. We say we're a safety regulator. Why that's hugely important is because having that safe system in which people can trust that the banks will stand up and are unlikely to be falling over anytime soon, that insurance and super is stable and safe, it forms the heart and the grounding of the system. because in countries where that has not been perhaps quite as well done, I come from the UK and lived through the global financial crisis, the cost to the economy is absolutely astronomical. And the effects in Europe are still being felt from the events of 2008. So we have to have that safe and stable underpinning. Now, with that in mind, however, there are areas which can be changed in our approach to them, and we've offered up several examples of that to the Treasurer. Very often those are things that will require some government intervention, they're not things we can just do for ourselves. But where we can offer up efficiencies that we can do on our own, we are doing that. And where we can work better and more seamlessly with other regulators in this ecosystem, we're very focused on that as well.
Thanks, Margaret. And I think great to kind of tie that into some of the past experience around that risk-based approach and ensuring that we get the balance right. And there has been a lot of talk about, reducing regulation, when we're having all these talks about productivity and economic reform. And I think at high level, that is the right way to go, but it's making sure we do that in a way that gets us the best outcomes for everyone in our community, not just one sector. And sounds like all three of you are really taking that sort of approach, which is excellent. Margaret, I'm going to stay with you for the time being, and you touched on a little bit in your opening comments around the role of cyber and the risks there. And I think for most people in the community, they're getting more and more concerned around, what the risks are with cyber. We're seeing more and more data breaches, concerns there. Can you talk us through in a bit more detail what APRA's role is there and what you're really doing to manage some of those cyber risks around the financial system?
Sure. Well, you're right. We've seen an uptick in cyber attacks that are coming to some crystallized form. We've seen that earlier this year, but we've been seeing things for a number of years, and APRA's been in this space beating the drum since at least 2018 when we first put out our security Prudential standard, that's our CPS 234. And between 2001 and 2003, we required 300 of our regulated entities to undertake independent assessments of their cyber risk controls. And we have observed good progress, but the pace of improvement, I think, has been slower than expected. So we've been really cranking things up at our end because the threat landscape has been getting, heightened, obviously so. And in our view, cyber risk should be seen as a whole of business risk. It's not just a tech risk. We expect boards to provide greater oversight and governance in technology and cyber investments as well. So one of the critical issues, one of the most pressing issues has been weakness in authentication controls. The recent Prudential stuffing attacks that people will have heard about or read about show that many super funds still weren't meeting the expected standards, especially when it comes to protecting sensitive member data and higher risk transactions. Now, that's not just an issue in super, but we do think super has had lower maturity. It's been later to regulation than the other industries that we regulate. So we've recently written again to super trustees to reinforce our expectations around information security and the implementation of robust authentication controls. Multi-factor authentication or equivalent needs to be in place for all high-risk activities and privileged access. And that is something that I think the recent events have really helped us drive forward, because we have been flagging that for a while, but there was some resistance about how that could get in the way of access for members and consumers. But I think now it's very well understood the risks that go with cyber attacks.
Thanks, Margaret. Mary, have you got anything you might want to weigh in on there around how your members are preparing and taking appropriate action against cyber risks?
Yes, I would say at the outset, all of APRA's observations, I think, are entirely correct. Not that I'm marking homework, but that the tension in super for so long as a compulsory product, trying to get people to engage with super has, I think, meant that we've given a real weighting to a smooth member experience, not wanting to put any friction in between a member showing up and checking their balance and that balance showing on screen, which means that there were controls that we'd naturally accept as humans in other places of our financial services environment, like in banking, not in place in super. And now the sector has turned its attention to that, and with the focus from APRA, which, as you can imagine, often helps to focus efforts in a fund, then you get that uplift there. But whilst we're doing those sort of, you'd say more basic protection initiatives, we've also got to think about how we coordinate. One of the best lessons out of the last incident was the coordination efforts, I think, and that's reflective for us as an association. So we've got to think, well, what is our role in that coordination, and how do we make sure that that role is additive and it is preventative as much as it is reactive if something happens. If we take lessons from the banking sector, something actually happens all the time. So we also need to make sure we're right-sizing the approach of coordination. So I think in the last 6 months or so, the sector has gone from something that probably didn't please the likes of the regulators on screen and others, and now we'll begin to be top of the game. We need to test that though. We don't want live environment testing. We don't want to go through another incident where we haven't tested all of our uplift. And so what we've been able to do is firstly worked on a sort of coordination framework. So we've got to embed that. You can write a lot of these things down, have a lot of agreement about them, but we want to put it through some rigour. We've also uplifted, people's understanding and governance. We've done a lot of learning, obviously, as an RTO. We've worked with the National Office of Cyber Security. They've got a financial services playbook, and ASFA's now named in that playbook as a coordinating agency, and so we can sort of start to funnel some information through. The funds will always have their obligations to the regulators, and no one should be in between that. What needs to happen, though, is that because there are, there are a number of funds, if there's more than one, under attack at any time, how do those funds start to coordinate, meet their obligations to regulators, meet their obligations to their members to communicate, but also then meet the obligations to the sector in order to start to prevent the harm. So those kind of things are written into the playbook and the framework, and that will be ongoing. And we're also looking at a number of pretty exciting, I think, digital utilities in order to better share and collaborate in real time. So there's a lot of work going on. I think that the next time the sector is tested, and this is going to happen, we will find that coordination piece will be in place. One of the best things we need to do is to continue to be a very hard target. So whilst we look at multi-factor authentication and uplifting that so that you have to put more details in, how else can we be a hard target in super? So we have to keep ahead of the technology game as well, and so we've put some things in place to be able to make sure we're bringing knowledge into the sector as well. But it's been an enormous piece of work, as it should have been, really.
Thanks. And, I think this is an issue not just affecting super financial services, but really every single industry and business in Australia. I think we're seeing that more broadly. I'm going to change tack a little bit here and want to talk a bit more about financial literacy. And Mary, I'll start with you, and really interested in your thoughts on financial literacy and consumers, and particularly as we're moving and we're seeing the super system develop from, what's been a pretty big accumulation phase, but now moving more and more to actually people using super to fund their retirements, and what the role of financial literacy is there, and consumer understanding of options that they have available to them.
Yeah, I think financial literacy is it's a term I've had problem with for a long time, because it was often coupled with a conversation about gender-based, balances, as though if only women knew more, surely they would have more money. So I do actually, it still gives me a bit of a when I hear that, but it is, if we think about it as a good base of knowledge to make the good decisions, it is a pretty crucial element to any kind of financially mobile society. The thing about super and financial literacy is that it was designed, because it's a compulsory product and it's got some default provisions in it, it is designed to do what it should do, whether or not you can make a decision or not, or whether you engage with it or not. And so I think, I think this is proven by research, obviously, that Australians do better when they engage, when they make decisions for themselves, when they have enough knowledge to make those decisions or they get some advice. They will do better because of the, I think, the interconnectedness of different elements of their, for example, retirement. So it plays a pretty crucial role, but there are really good protections in place in super for people to walk through their life without having to have that base level of knowledge. This is good. This is not something that to think, well, that's very apathetic. And it's interesting because we've got, you know, such a multicultural society. We bring workers in who may not have necessarily the English as a first language, and so we do need to make sure those protections, etc., are in place, and that super will do what it will do for them from the very beginning, whether or not they can engage with it, because the way in which we talk assumes English as a first language for a start, and could, you know, so could be improved from that sense. What I think we've learned over time at ASFA is that people need sort of little bits to be able to make good choices. So we've done a retirement standard. That's been operating for about 20 years. That was born, I'm told, obviously it predates my appointment here, but that was born out of a need of people saying, I don't know what I'm aiming for. I'm like, how much and when? And so whilst we hope that people seek, you know, good advice or at least some help from the funds and things, there's also that to check how people are tracking along. We recently, it did for a long time assume home ownership. We recently did a rental version of that standard as well. It just really helps people benchmark along the way. With financial literacy, or, you know, let's say good base of knowledge, we think we still need to sort out the advice environment. And it is imperative, and I think not beyond us as a nation, to think, well, we've got one of the world's best retirement systems. Can we make sure we have the capacity of people to make the very most of it at all times? So that's, I think, something to be sought out at a legislative and regulatory level, because there is you know, an advice environment and a superannuation environment don't necessarily coexist nicely right now for the benefit of the members when they're trying to make good decisions.
Great, thanks, Mary. Tim, I was really taken with some of your stats in your opening remarks around, you know, half of people who are experiencing personal insolvency have debts under $50,000. And I think that just really highlights how financially vulnerable some members of our society are. So just wanted to delve into that a little bit more, and with a bit of that financial literacy lens as well around, you know, how do we support people throughout their lives around understanding their finances better, financial vulnerability, and, you know, hopefully ensuring you have fewer of these insolvencies coming through.
Yeah, look, thanks, Cass. This actually, you can go back to the front of our conversation about the productivity discussion we had around, and the conversation around then, and no doubt one of the key enablers for productivity is around skills and training and education. So at a real core level, it goes all the way back to our education system, and how do we educate people, you know, at quite young ages, just to, you know, really understand the importance of just how to manage money. And so at one level, it goes all the way back to skills, training and education, and how we actually frame our education systems to actually equip young Australians all the way through to, obviously, older Australians to think about their financial well-being. As a wash of that, and where we are is a lot of, as you pointed out quite correctly, a lot of people who fall into our system with remarkably small levels of debt. I mean, it's a lot of money for them. I'm not suggesting for a moment 50,000 is not a lot of money. It is for them, but for the system, it really isn't a lot of money. But they fall into it, and often they've fallen into that situation just due to not having the right information and the right advice or the right level of financial understanding at key moments in their life journey. look, and then overwashed by that or overlaid by that, they can also be in situations where there's financial, physical abuse, domestic abuse, financial vulnerability. And so you add into this cocktail of one, limited financial understandings combined with just challenges of life, losing a job, financial distress, various vulnerabilities, and suddenly you get them into this really, really distressful period, and they then start making poor decisions, not neutral decisions, actually poor decisions, which can lead them down the pathway, which ultimately ends up in our system. And so, some of the things we're doing in terms of collaborating with regulators, we work very closely with ASIC, which is another conduct regulator. They have a terrific thing called Money Smart. And Money Smart, we're always encouraging people to go onto that website because it really gives people some steps about how they handle their current situation. And so there are vehicles like that are available. Clearly working with financial counsellors. The financial counsellor sector are there to really help people navigate those real difficult moments, and how they manage through that. But Cass, it's really worth highlighting that the people who actually end up coming down, if you will, we are a bit like the credit highway. You take that off ramp to get off the credit highway. That off ramp that we have, a lot of those people who take our off ramp, they're primarily renters. They don't own a house. Only 6% of the people in our system own a house. 90+% are renters. So when you think of the cost of living, and you live in Perth, so I'll give you this better than I, but the rental prices in Perth have just gone through the roof over the last 2 to 3 years, 20+%. So if you're a vulnerable Australian renting in Perth, dare I say renting in Sydney or any other major capital city, the cost pressures you're now dealing with are profound. And then add into that cocktail your own literacy, and then your surrounds of, dealing with, dare I say it, domestic violence, poor choices can very quickly get made. And that's kind of like the circumstance they find themselves in. So wrapping around support, financial counsellors, we obviously, and I haven't even overlaid the additional things that Mary just touched on, but English may not be your first language. That adds to the complexity. How do we simplify the system so that we can actually help those people who English is not their first language, they're under serious distress, and how do we provide them a pathway to navigate through? These are some of the things that are really quite practical, but things that we deal with day by day.
Thanks, Tim. And I think that, really shows some of these broader economic issues, particularly on the housing market, and kind of these general inequities in our economy and community, and how that can really play out, particularly in populations that are, maybe starting off from a more vulnerable standpoint already. While we're talking about kind of the consumer end of things, Margaret, I just wanted to throw to you, and I think it would be remiss of me having this conversation to not at least bring up that, we have seen a lot of media coverage recently about losses sustained by superannuation fund members that had investments in First Guardian and Shield. Just wanted to touch on that and get a little bit of information from you about what APRA is doing about it.
Sure. Well, I think the first thing to say is that the funds you mentioned are managed investment schemes. They're regulated by ASIC, so perhaps not surprisingly, ASIC is taking the lead on this work, excuse me. And there are investigations underway, which really limits what I'm able to talk about. We're working with ASIC to ensure a robust supervisory and enforcement approach at a system level, and to support their investigative work with the relevant trustees. And that goes to that theme of we're an ecosystem that I mentioned earlier. Obviously, it's very, very concerning if people have lost their savings, and it speaks to the importance of a number of things. One of those is trustees having strong investment governance of the products that they offer on their platforms. And strengthening trustee governance over investments is an area that we've been focused on for some time. Excuse me again. In recent years, we've strengthened our regulatory settings over that, enhanced supervision and conducted a series of reviews. And we're in fact in the final stages now of a deep dive into trustee practices in relation to the investment governance of platforms. Key themes there are trustee due diligence and monitoring, and the level of reliance on third-party reviews. I better have a drink of water.
Well, yeah, happy. Why don't we move on and we can come back to you, Margaret, if you want to add some extra comments on that. Tim, I've just, in Pigeonhole, we've got a fairly specific question for you that I thought I'd ask. And in terms of what you're talking about around financial literacy and vulnerability, we have had a question come through on buy now, pay later schemes, and what you think the role of those is in financial distress.
Yeah, look, thanks for the question. Just to give you the facts and figures first, buy now, pay later in our system 5 years ago was, in terms of volume, was basically less than 5% of the volume that we were seeing on the creditor side. Now, basically, buy now, pay later is in 50% of personal insolvency applications. The numbers are very small. As you would know, I'm sure the person who put this forward knows, buy now, pay later is usually a couple of $100. So the volume is large, but the value is quite small at the moment. So still, creditors like the banks, like the ATO, are still much larger in terms of value. But in terms of volume, they are well and truly a very significant part of the system. Look, there's an important conversation to have, which is around being a responsible lender, and that is a really important conversation for all creditors to be cognizant of, that the ultimate purchaser of that particular credit product genuinely understands what they are purchasing. And I think there are some cases where there's some work in progress, if I'm honest, about some of the behaviours that we are seeing with some of the lenders in some of the buy now, pay laters, it's absolutely appropriate that we all understand the risk-reward equation, more risk, more reward, but it needs to be put in a context of understanding the genuine position that particular lender is in. And we are concerned that there are some operators who aren't following through with some of the right social license to operate.
Great, thanks, Tim. And the financial literacy topic seems to have sparked quite a lot of questions on Pigeonhole, so we'll just stay with it for a little bit longer. And Mary, just want to throw a review, and we've got a bit of a follow-up from some of the comments you made about women's financial literacy, and that's often kind of shown as a bit of an issue, and whether you think there is an underlying concern there, and whether we're doing enough to kind of adjust that balance and the gender segregation in financial literacy.
We're not doing enough to adjust the balance, full stop. I'm not entirely convinced that women know less. I'm entirely convinced that they have less money. But the drivers of that is not less intelligence or knowledge, it's less pay. So I think we need to be very careful that when we're looking at gender disparities and wondering what it is we can do, we stay very much at the system level, because that's where the disparity actually occurs. So we can uplift financial literacy, I think, in general across the population. What that will do, absent any other solution for gender disparity, is help the women who have less balances understand why, but not help them have more money. So I think that both things can be done, but one shouldn't be done in absence of the other. The drivers of why we get so, I guess, worked up about this in superannuation is because superannuation is a magnification of what happens in your working life. And it takes everything that you're able to, earn and do in your working life, and it presents it back to you in retirement. And when you've got one half of or just over of the population who will take time out of the workforce more often than not to either raise another generation or look after an older generation, will participate more in part-time work, will be paid less than their male colleague with exactly the same skills and exactly the same job title, then you're going to have worse outcomes at retirement. So you will be economically you'll be worse off economically for adding to society through your working life. So I think if we sort of wrapped all that up and presented that in a bow of financial literacy back to those women, we probably haven't done our job. We need to be able to make sure we're hitting the drivers of that equity from the very beginning.
Great, Mary. That was a beautiful explanation, I think, of what the underlying problem is there. We are somehow rapidly running out of time, and I wanted to make sure we touch on the topic of collaboration amongst the regulators. And Margaret, I might start with you on this one, and just a little bit about, first of all, if you did want to add any comments about what we were talking about before we had to move on, but then also a little bit around how APRA is collaborating with others in the regulatory system. And you did mention when we were talking about the superannuation funds that were having challenges that ASIC was dealing with a fair bit of that. So really interested in a little bit more around collaboration.
Yeah, so sorry, I'm pretty well finished, but just to remind that we're doing a deep dive into trustee practices in relation to investment governance and platforms. That will be coming out reasonably soon. On the subject of collaboration, yes, I mentioned we have different mandates, but we need to work together to the good of the system. Some of us have formalised arrangements with MOUs, some have less formal arrangements. Obviously, at the top of this structure is the Council for Financial Regulators, which is APRA, ASIC, RBA and Treasury, who meet about the most serious system matters, if you like. And there is much collaboration there. And most recently, we collaborated in a review that the Treasurer had asked us to do on small and medium-sized banks, for example. But at a working level, our closest relationship is definitely with ASIC. They're the conduct regulator, we're the prudential regulator. They're really set up more of as an enforcement agency. We're a supervision agency. Obviously, there are crossovers at margins, but we will very often get together to discuss the work we're doing, to look at particular cases what issues might be common in those cases, what is a correct approach to tackling any issues that arise. So those relationships are really very important because there may be overlaps between our mission statements, if you like, and there may be gaps, but we've got to work very hard to make sure that the gaps don't increase or don't lead to harm that is occasioned because of that gap. So we're always trying to work out how we can work together and do the best we can for the system.
Thanks, Margaret. Tim, I'll throw to you, but I'm giving you a 60 seconds or less time limit on anything you'd like to add around collaboration in the system.
No, look, thanks, Cass. And look, just to build on Margaret's reflections and her word ecosystem, we are absolutely in the ecosystem together. We're an observer at the Council of Financial Regulators, not a member, but an observer. We work most closely with particularly the ATO. They are our largest creditor, and so they're inside our ecosystem. And obviously ASIC, which is our fellow conduct regulator. And we work across the system. I mentioned systems vulnerability earlier. So we're sharing vulnerability with each other about how we go about that. We're working about systems efficiency. How do we become more efficient? We're sharing that with each other about how we improve our efficiency. And finally, systems misuse, where people are doing deliberate and willful harm. We are working, in fact, for those who've read today's AFR, you'll see something in today's AFR where ATO, ASIC and ourselves are working together on a particular misuse issue. So there's your 60-second answer.
Fantastic. Mary, I'm going to give you the final word. Again, you've got 60 seconds or less. Anything, slightly outside the regulatory, anything kind of broadly on collaboration throughout the industry?
I think it's collaboration in an ecosystem takes into account the role of associations and think tanks and, policy thought leadership as well, because and then implementation, because it is we love to see collaboration between regulators to make sure that there's sort of a single, a tell us once approach, which we've been talking to the Economic Roundtable about as well. We think there's some efficiencies to be gained there, but there's some efficiencies that we can drive as an association as well in the implementation of regulation and making sure that there's consistency. I'm quite sure the regulators at the other side of some of the data that we said would prefer that we all had consistency in definitions, for example, because that gives them efficiency as well. So if we're talking about good collaboration, I think it looks like the whole ecosystem, really, the whole community, on a mission of making sure that the regulation is strong, because that gives confidence to the people who are existing within it, but that it is also efficient, so that it doesn't it overly burdens them or it doesn't lead to unintended consequences in the areas of investment, for example. So we're sort of singing from the same song sheet, but we've got very different roles to play, but they can be quite complementary, I think, in a world where it works really well.
Fantastic. Well, we are out of time. Such a great discussion today. I think I certainly came away with a better understanding of where everyone fits in the ecosystem, and really great, I think, to hear everyone's on very similar page around making sure we've got an efficient and effective financial system that does allow for Australians throughout their lifetime to have that security in their finances and hopefully assist those with a bit more vulnerability. Thank you, Tim, Mary and Margaret, for your time today. We really appreciate it. And thank you very much to our audience for your active participation. It makes it all the better. Before people log off, would encourage you to jump into Pigeonhole and rate today's event. This discussion has been recorded, so everyone will receive a link to the recording. And so we encourage you to share that with your colleagues and networks, and maybe come back and have a bit of a listen if there's something you missed a bit the first time. Please, everyone, stay in touch and head over to ceda.com.au and to have a look at what we do have coming up. We have a broad range of events in all states. And for those of you that love a live stream like today, the next live stream coming up is on Tuesday, the 9th of September, which is around the future of international students in Australia. So again, really, really topical discussion, and which I'm sure will be fantastic. So thank you. Enjoy the rest of your days and have a lovely weekend, everyone. And thank you again to our presenters for their time today.